All right, I want to tell you another story. This is a Yale story. Joe McNay was I think he was a Yale graduate. The class of 1954 was celebrating the 25th anniversary of their graduation. That would be in 1979. And somebody said, this guy Joe McNay is a great investor. Why don't we, as a class, give money to Joe McNay and just ask him to invest it for 25 years and turn it over to Yale University as our gift. But we don't turn it over now, because apparently they thought that the Yale portfolio was not managed well at all. And so this was before David Swenson became the head of the Yale portfolio. So Yale was investing in government bonds and safe things like that. They couldn't stomach the variation that you see in investments. But Joe McNay was just this creative guy, and they said, hey, you know, this is just our celebration for our 25th anniversary. We don't care about this $370,000. We want you to invest it for maximum returns, and you can take chances. We're in the mood. Hey, we're all having our beers together 25 years later. It's, you know, it isn't often that investors will tell that to an investment manager. So, right? You don't say, if you lose all of it, well, okay, we don't care. But we think you can do it, so please try. So Joe McNay invested it in Walmart, Home Depot, and some internet stocks. So he took Walmart as this, it's like an Apple corporation, really volatile. But he thought, well, they've told me I can do this. And so he gave the Yale University $90 million. Quite a success. Now, the question is, I was already suggesting that there's an issue of outliers. So what do we mean by an outlier? Well, there's something I'm sure you've heard about, the normal distribution or the bell-shaped curve for random variables. The normal distribution is a typical distribution for random variables in nature. There are reasons to think that many random variables follow a distribution like this. The distribution has two parameters, its mean and its standard deviation. So in this case, I have plotted it for two different standard deviations, but both a mean of 0. So this is a theoretical probability distribution for, let's say, a return on a stock. And here the standard deviation is 1 on this pink curve, and it's 3 on the blue curve. Many random variables in nature follow this distribution, but not all of them. And that's important because in finance, it tends not to follow this distribution, that we tend to have outliers or fat tails. So this random distribution, the normal distribution, has two tails. This is the right tail, which is high values of the random variable, and here's the left tail, which is low values of the random variable. And the height reflects the probability of getting that value. So if this were the distribution of returns for Apple stock, and let's say standard deviation of 3, of 3%, let's say, then the probability of getting a return of 3% is pretty good. Well, here's 3%. And the probability of getting 3 standard deviations out, that would be 9, you can see is just about negligible. And then I don't even show it anymore. The probability of 4 standard deviations out is essentially 0. That's what the normal distribution says. Now, the normal distribution has been used to describe, for example, human heights, or human IQs, or SAT scores, or lots of things seem to follow the random normal distribution. And you probably have become intuitive about this. If you see some random variable repeatedly, and it's always been, pretty much always been between, say, -5 and +5, then intuitively you start to think it can't happen that it would be 15, because you're intuitively trained by your life's experiences. But in fact, there are other distributions that are more characteristic of financial returns. So there's another kind of distribution called the Cauchy distribution, and after a famous mathematician. And what I'm showing here is 100 draws from the normal distribution in blue, and 100 draws from the Cauchy distribution in red. Now you see the difference between the Cauchy and the normal. The normal distribution has a kind of look to it. It looks, you see, it's going up and down about the same amount all the time. Well, I'm not saying that exactly right. The probability that it would be 10 times the normal change, the usual change, is negligible. So you never see it deviating from, it has a kind of uniform look to it through time. But with Cauchy, it also looks very much like normal. You can't even tell them apart for long intervals of time. And then bang, there's some big positive value. In other words, the distribution under Cauchy is fat-tailed. So the Cauchy looks like a normal distribution, except instead of just trailing off to 0, the distribution continues out above 0, way out. So you can be deceived by a fat-tailed distribution like the Cauchy into thinking that you're living in a fairly stable world whose risk I understand. But the problem is there are these big events that occur from time to time. The central limit theorem in statistics says that averages of a large number of independent, identically distributed shocks or random variables is approximately normally distributed. But that central limit theorem assumes that the underlying shocks do not have fat tails. So if you're taking the average of stock market returns, which tend to be fat-tailed, then your average is not a good indication of the real average over long intervals of time, because you might well have gotten a sample where none of the fat-tailed outlier stocks. So my friend Nassim Taleb has written a book called The Black Swan, which got a lot of attention, referring to black swan events. So you've seen a lot of swans in your lifetime, and they've always been white, right? Have you ever seen a black swan? So you might well conclude that black swans do not exist. But in fact, they do exist. There are black swans. And so that's the metaphor he uses for a fat tail. So here is a plot of the normal and the Cauchy distribution. So the Cauchy distribution looks pretty much like the normal. It's a bell-shaped curve. And it trails off, but there's a subtle difference. That there are these rare, but they're not quite as rare as the normal would suggest. So the real world puts fat tails in our lives. So here is a plot of it's a histogram of daily stock price changes since 1928. And what this thing is, on how many days there are since 1928, but it's tens of thousands of days. And so what we're seeing here is that the stock market yielded a return of, this is for the S&P 500, or extended S&P 500, of between, I guess this is between, or of 1%, with some interval around that. It did that on something like 9,500 days. It earned plus 1% on one day, and then on something like 2,500 days, it earned plus 2%, and then on something like 800 days, it earned plus 3%. On what's that? Looks like it's about, I don't know, 400 days. It was plus 4%. And then here, I can't even figure that out anymore, something at plus 5%. After that, they look like you can't even see them anymore. So you might conclude by looking at this histogram that stock market returns are always between, say, minus 6% and plus 6%. As a matter of fact, on October 30th, 1929, the stock market went up 12.53% in one day. And on October 19th, 1987, the stock market fell 20.47% in one day. It was quite a shock. By the way, on this day, I was lecturing, giving this class. I was teaching Econ 252. And one of the students was listening to a transistor radio. Do you know what a transistor radio is? It's what they used to have before you had iPhones and things like that. So he raised his hand. I'd never forget this. And he said, "Did you know that the stock market is crashing right while you're giving this lecture?" So I, instead of going back to my office, I just thought, what is he saying? I went downtown and I talked to my stockbroker at Merrill Lynch right here in New Haven. I took the elevator up and just walked in on them just to see what was happening. And it was this turmoil, and everyone, I did manage, because I walked in. If you tried to call your broker, you couldn't. He wouldn't answer. There's too many calls. But I walked in, barged in on him, and I said, "What's happening?" And he said, "Don't worry, don't panic." It was this big event, horrible event. But that was the biggest one-day drop ever in the whole history of the U.S. stock market. So I had the good fortune to be warned of it by my student with the transistor radio. The fact that my student, this is before laptops, but he did, we had problems with transistor radios back then. So that's an outlier. So the normal distribution with the same mean and standard deviation as this histogram says that the probability of a drop greater than 20% is equal to 3 times 10 to the minus 71 power. That's awfully close to 0 if you know. I think that the estimated number of atoms in the universe is bigger. That's 10 to the 80th power. But it's getting on like that. So it's essentially 0. But it's wrong because it happened. And I was there. I saw it happen. And I saw the excitement that it generated.
Idea of covariance when you have two separate stocks, for example?
Okay. All right, I'll try to start keeping things really simple. There's two stocks that we're looking at. They're two different companies. They're both startups, and they're both trying some risky new venture, and they both, it's like a coin toss, right? They both have a 50-50 chance of succeeding. And if they succeed, they're worth $1 million, and if they fail, worth $0. So we have two probability distributions, one for the stock 1, right? This is 1 million, and this is 0, and this is 0.5. I'll leave it at 50-50 for now. And this is stock 2, 0, 1, 0.5. So it looks the same. Now the question is, are these two businesses really independent? We've shown their probability of succeeding. But if I'm going to invest in both of them, as a smart venture capital firm might do, what do I make of that? Are they the same or different? So let's say the mean is 0.5 for both of them. It's like a fair coin toss. All right? And so they'll deviate either plus 0.5 from the mean or minus 0.5 from the mean, both of them. Now, but the question I want to know is, as an investor, are they going to do the same? Or are they independent of each other? There's 4 possibilities. Okay. The covariance, COV, covariance between the two returns is a probability weighted average of, now it's analogous to variance, but it's between two companies. Okay. So let's consider what's the first possibility? They both succeed. So it has a 0.25, 1 in 4 chance of being a half above the mean for both of them. So that's 0.5 times 0.5, right? And then it has a 25% chance of both being 0, of they both. So it's 0.25 times minus 0.5 times minus 0.5. But then there's the chance that one of them succeeds and the other one doesn't. And there's that has twice as that has a probability of 0.5 because there's 2 different ways it can go. Right. It could be A that succeeds and B fails, or otherwise. So we have a 5 probability of minus 0.5 times 0.5. 0.5. So what does that add up to? It adds up to 0, right? Because these are both positive numbers. But these are one, so the product, minus 0.5 times minus 0.5 is plus. And so this is equal to 1/2 times 1/4, right? The two terms here.
Right.
And that's the same here,
Okay.
but with the minus sign. So it cancels out. So if they're really independent like that, then the covariance is 0.
Okay.
And we like that as investors. We don't want to get in trouble. So we want to see independent investment. But on the other hand, it could be that the two companies are really the same. They're really betting on the same idea. And so these are not possible, all right? This probability goes from 0.5 to 0. And then this probability goes to 0.5. And this probability goes to 0.5.
I see.
So now we have a covariance of 0.25.
Okay.
It's not 0 anymore. And that's a flag that, there's danger here. And the other possibility, another possibility, is that they're exact opposite of each other. Mm-hmm. One will succeed if only one of the two will succeed. One will succeed and the other fails. And that would be a negative covariance.
Okay.
So these things matter, and they become central to our theory in the capital asset pricing model. This is something that's not in the habit of thinking of most amateur investors. They look at their investments one at a time, and they don't, but you always have to go back and say, what's the covariance? Right. That's what really matters for what happens to your portfolio, because when you invest in a lot of companies that are all the same, you're asking for trouble, because the whole thing is going to either blow up or succeed.
Right.
And you can't live like that. You have to be looking for low covariance. And the formula, the theory of capital asset pricing theory tells you how to take account of covariances.
Okay, so then really this covariance kind of changes based on how we assign the probability of each pair of outcomes occurring. So what's the probability of them both succeeding? Here we put 0.5. And then what's the probability of them both failing, which is like 0 and 0, so that would be 0.5. And we gave no probability to the case where one succeeds and one fails. So that kind of, the fact that the covariance is positive is kind of indicating that these two stocks tend to do this, they move in the same direction.
Right.
They're kind of simultaneously moving in the same direction. So
this is the basic bottom lesson. Risk is determined by covariance.
Right.
Especially if you hold a large number of assets. Idiosyncratic risk just doesn't matter. It all averages out. It's this kind of thing where they do the same thing that you have to worry about. And this is a basic lesson in finance. It just doesn't come naturally to most people. You have to ponder this.
So that's really interesting, because when we come to finance, most people think of that risk as just the variance possibly, but actually we're saying it's actually more granular than that. It's actually the covariance of a stock with, let's say, the broader market.
Right. Well, yeah, because any investor has the option of investing in everything.
Right.
Because there are mutual funds that will do that. There are world funds that put their money all over the world. And so why shouldn't you do that? Well, it sounds like it's a pretty good thing to do, actually, because they're getting, but the one thing they can't get rid of is the market risk for the whole world. That's there because no matter, if you hold the whole world, you're still subject to the world risk.
Right.
But that's what an investor needs to be focused on. And this is a bad habit among many individual investors. They just look at one stock and they think, I'm going to put all my money in that.
Right.
And they just don't consider how many different options for risk spreading they have in this vast world that we have around us.
Okay. And this idea seems quite similar to when we were talking before about the market return versus Apple, and yeah, so then we had different betas, and so that's kind of getting at covariance.
In fact,
inside.
the beta of the I stock is its covariance with the market divided by the variance of the return on the market. It's just a scaled covariance.
Okay.
And the average beta has to be 1 because I could substitute the average return on the assets, and that's the return on the market. So then the covariance of anything with itself is equal to the variance, and it's just 8 equals 1.
Okay. So then, if you're more than that versus less than, I see. Okay.
So you want to be careful. In other words, the basic CAPM says that the market demands higher returns from high beta stocks. That means high covariance with the market stocks. And they're willing to take low returns if the beta is low, because that means it's less contributing to risk on the portfolio.
Okay.
In fact, if you can find a negative beta stock, or let's say gold, it may not always be negative beta, but let's say in theory it's negative beta. Putting gold into your portfolio, it has no return at all. It doesn't pay dividends, nothing.
Right.
But it moves opposite your other investments. That's the theory.
Okay. And everything that we're talking about here, we have this presumption that we're all risk averse. And so I just wanted to state that that's a key part to why we care about covariance. Yeah. But if there's somebody like George Soros or Warren Buffett, maybe they're less risk averse.
Well, I have no fundamental insights into either George Soros or Warren Buffett. Right. My guess is, though, that they have this theory firmly in mind. And they may want to take risks at times. See, the real world is not so cut and dried, as I showed here, but we know the probability of everything. So they may disagree with other people, and maybe they're smarter. Maybe they work harder. Right. So they won't always minimize their risk. The CAPM model is an abstraction and idealization, and it assumes that there are well-defined probabilities for everything. But in fact, I don't think anyone behaves entirely in accordance with this model. I'm thinking of it as it's actually a fabulous model as a first step in thinking about financial markets, because it can prevent you from making a lot of mistakes. So today we wanted to talk, the idea was to talk about insurance. And it's a very old idea. In fact, in some sense, it even is used by animals, non-human animals. If they share risks, then it's some kind of insurance, maybe. So it's very basic. And I think you have some idea already what insurance is. But it involves an insurance company of some kind, or a government insurance. But the policyholders have a contract with the insurance company to protect them against certain well-defined risks. And for that, they pay a premium, a regular payment to the insurance company for its standing ready to manage those risks. So they achieve there's a theory behind insurance, and the theory is risk pooling, that what is a risk for one person is not a risk for society at large if they are independent. Because by the law of large numbers, the number of bad outcomes are fairly predictable. The insurance company pools all these risks, and by the law of large numbers is not really risky in itself. Now, there's a little mathematical formula for risk pooling, which is assuming independence. If let's say it's a life insurance, if every death is independent of the other, there's no epidemics or wars that bring a lot of deaths all at once. then the risk that you face if you're writing n policies, each against one life, is the standard deviation is given by the square root of p times 1 minus p, where p is the probability of death, divided by n and the square root of that. And you can see that as n gets large, the standard deviation approaches 0. So the fraction of policies that result in death becomes practically a known number. That's the key idea of insurance.
According to the law of large numbers, the average of the results obtained from a large number of trials should be close to the expected value, and will tend to become closer as more trials are performed. The law of large numbers is important because it guarantees stable long-term results for the averages of some random events. So let's take an example. While a casino may lose money in a single spin of the roulette wheel, its earnings will tend towards a predictable percentage over a large number of spins. And that's how the casino can confidently pay its monthly bills. Another example would be if we took a 6-sided dice and rolled it many times. The average of their values, sometimes called the sample mean, is likely to be close to 3.5, with the precision increasing as more dice are rolled.
So unfortunately, it's not so easy to make this idea work in practice, largely because of moral hazard and selection bias. Moral hazard occurs when people, knowing they're insured, take more risks. So for example, if your house is insured against fire, you may say, I don't care, I'll be careless with fire because it's insured. So then the risk goes up. Or even worse, if the insurance company insures your house for more than you think you can sell it, you would say, I'll just burn it down, I'll pretend it was an accident. And then I'll get more money than I would have for selling the house. Selection bias is different. It is that the insurance company may not be able to see all of the risk parameters that define risk. Then the customers may see them more. So for example, health insurance tends to attract sick people. So health insurance companies ask for a medical exam traditionally to screen out people who know they're already going to be sick. If they're not successful in doing that, then the selection bias can harm their business. And it can destroy an insurance business, because if people know that they're going to be sick, then only sick people sign up. The insurance has to be expensive, so healthy people won't sign up because they don't want to pay the expense. And so the whole thing collapses and doesn't work. So you have to deal with selection bias the best you can by exams and disclosure, and also by the government can make it mandatory that insurance companies do not look at the selection. So Obamacare is known for that health insurance companies are not allowed to take pre-existing conditions into account. Well, let me give you an example of moral hazard and selection bias in insurance. Many people in this world today are living in marginal economies, subsistence farmers. You have a farm in some very underdeveloped part of the world, and you depend on the crop every year to feed your family. But unfortunately, the weather throws curveballs every now and then. There'll be a typhoon or there'll be a drought of some sort. So the farmers should buy insurance, right? But how do we do that? So one kind of insurance that's been offered for many centuries, I suppose, is crop insurance. So the farmer buys insurance against the crop failing. That sounds good and workable. There's a problem with it, though. The problem is that it's subject to manipulation. The farmer can lie about the crop, right? He can say, I didn't get much of a yield this year. He can sneak some of it off and sell it, and then try to claim on the insurance. Or the farmer can just get careless. Maybe he's just not that focused a guy, right? He doesn't do things right. He gets drunk and it doesn't do the necessary thing. That's moral hazard. And then there's selection bias. Farmers who know that they're living on marginal land will pay for will be the ones who will go for the insurance. So crop insurance has been around, but it hasn't worked that well. So this leads to an advance that occurred in the last 20 years or so, as pushed by the World Bank, which is an international development institution. How about insuring the weather instead of the crop? Okay? Because the farmer can't cheat on the weather. He can't make bad weather. We have weather stations. So that's like a good idea? Well, it's a new idea, weather insurance for farmers. And it's starting to catch on, especially in the developing world where it's extremely important. It can be life or death for some of these farmers. But then, does that sound obvious and workable? Can you think of any problems with weather insurance? You have to define the weather very carefully if you're going to describe the effect on crops. That it turns out that you plant seeds on a certain date and they start germinating. They're very vulnerable to drought after a certain number of days after planting. And if the bad weather comes right then, so you have to measure it locally and know exactly when the planting was, details like that to make it work.
Along the lines of moral hazard that Jason mentioned, you cite us an article that says that we're transforming from the financial capitalism into more of the philanthropy capitalism. And my question is, do you think that the increase in the number of philanthropists and NGOs causes people in the developing countries to have less of an incentive to insure against natural disasters?
Okay, well, that's a complicated question. The reason we want insurance as opposed to gift giving is because insurance is much more logical and priced out, so we know exactly what costs and what you can expect. So, for example, flood insurance in this country was created to prevent people from making big mistakes. The big mistake that was being made was that a lot of people were building houses in floodplains. And, with sometime in the next 20 years, it's going to be a big flood. And then these people are apparently counting on, well, someone will bail me out. So in the United States, in 1968, Congress passed the National Flood Insurance Act, which specified that you had better buy flood insurance and the government will subsidize it, but it will be priced appropriately. So if go ahead, build your house in a floodplain, but you're going to have a sky-high insurance rate. We're going to price it out. And that's the idea. So people, are forewarned. You better watch out because this is a high-risk area, and the flood insurance rates will tell you that. So that's a coherent system. If it's just philanthropy, then lots of people would be building on a floodplain. So you've got to have it priced out and done right.